Imagine this for a second. The money you see in your bank account doesn't actually exist. I know it sounds crazy, but it's not a joke and it's definitely not conspiracy talk. If everyone walked to their bank tomorrow to withdraw their money, the whole system would collapse in a matter of hours. Because the cash simply isn't there. And no, this isn't a mistake. It's exactly how the financial world was designed to work. A system so old, so deep-rooted, that we've accepted it without ever questioning it. This idea is called fractional banking, the quiet engine behind inflation, debt, and the illusion of wealth. But to understand why the system exists, we need to go back in time. Back to a world before apps, screens, and digital balances. Long ago, money meant gold and silver. If you were wealthy, you had coins and gems locked away. But carrying bags of gold around was dangerous and exhausting. So people started leaving their valuables with goldsmiths, men who had secure vaults. In return, the goldsmith gave them a simple receipt, a note saying they could come back and collect their gold whenever they wanted. Over time, people realized they could just trade the receipt instead of the actual metal. It represented the value just fine, and it was a lot easier to carry. And this is where the trick began. Goldsmiths noticed something interesting. Their customers almost never came to collect their gold at the same time. Maybe one or two people showed up a day while the rest of the gold just sat there doing nothing. So the goldsmiths got clever. If they had 1,000 coins, they started issuing 2,000 receipts. They loaned out those extra receipts at interest, money that didn't actually exist. As long as people didn't rush in all at once, nobody noticed. They were literally creating money out of thin air. This tiny trick eventually became the blueprint of modern banking. Banks were built on the exact same idea, and by the 1600s, governments adopted it too. When England founded the Bank of England in 1694, it wasn't created for the public. It was created because the king was drowning in war debt. The bank loaned him far more money than it actually had, and the debt was paid back from the taxes of ordinary people. Sounds familiar, right? America followed the same script. Banks issued paper notes backed by gold, but quickly learned they could print far more notes than the gold they really held. When people panicked and tried to withdraw their money, banks collapsed. But instead of ending the system, governments chose to reinforce it. They created central banks to keep the illusion alive. Fast forward to today. If you deposit $100 into a bank, you probably think your money sits there waiting for you. But banks used to keep only about 10% of your money and lend out the rest. That meant your $100 could eventually turn into nearly $1,000 circulating in the economy, even though only $10 of it was actual cash. And here's the shocking part. This system is now outdated, because in 2020, the reserve requirement in the US became zero. Banks no longer need to hold even a single dollar against the deposits they take. So how do banks stop themselves from lending infinite money? Today, the real leash is something called the Basel Rules, global regulations created by central bankers and technocrats in Basel, Switzerland, not by presidents, not by parliaments. Unelected officials set the rules. And under this system, banks don't lend from deposits anymore. They create loans first, and the loan creates the deposit. When you get a mortgage, the bank isn't pulling money from a vault. It's literally typing new money into your account. That money exists because you agreed to pay it back. More than 90% of the money in modern economies is bank-created money. Digital money that exists only because someone went into debt. Not cash, not central bank reserves, just numbers on a screen. And this design creates three unavoidable consequences. 1. Inflation. Money keeps multiplying faster than real value. Prices rise. Your savings lose purchasing power. 2. Endless debt. Since money is born as debt, there will always be more debt than money. Someone must always borrow more. 3. Concentrated power. Banks earn interest on money that never truly existed. Governments borrow endlessly without raising taxes. And people who own real assets, land, property, stocks, get richer as inflation pushes values up. Meanwhile, ordinary workers fall behind. History shows what happens when confidence breaks. Bank runs in the 1800s, the Great Depression, the 2008 crisis. Each time the same pattern repeats. Confidence collapses, the illusion cracks. Governments step in and patch the system so it can keep going. And globally, the US and Europe have no reserve requirements. Developing countries still use them, but even they follow Basel rules. No matter where you live, money isn't created from deposits. It's created from debt. And here's the part nobody likes to admit. If every household paid off their debts tomorrow, the money supply would collapse. The modern economy requires borrowing. Without debt, the machine stops. So what does this mean for you? It means bank balances aren't real wealth. Real wealth is land, skills, knowledge, resources, and independence. It means debt is not just a tool. It's the fuel of a system that benefits lenders more than borrowers. And it means inflation isn't an accident. It's built into the design. This isn't fear-mongering, it's awareness. If your money is born from someone else's debt, then your financial freedom depends on stepping outside that cycle. Understanding the system is the first step. Ignoring it means staying stuck inside it. History may not repeat exactly, but it always rhymes. From medieval goldsmiths to the bank panics of the 19th century to the housing crash of 2008. It's the same story told in different eras. Promises multiplied beyond reality. A public that believes until belief becomes impossible. And the truth is, this story isn't over. Every financial crisis reminds us that the system isn't held together by gold or productivity. It's held together by trust. And trust is the easiest thing to lose. So the next time you check your bank balance, remember, most of what you see is just numbers on a screen, not real money, just debt disguised as wealth. If this gave you a new perspective, I'd appreciate it if you subscribe. More videos like this are on the way, and together we'll uncover the history that shapes your world.